Okay, I want to start today with a very specific scenario.
Okay.
It's a Tuesday morning. Maybe you're stuck in traffic on the outer ring road,
Yep.
or you're just grabbing that mid-morning chai.
Yep, I can picture it.
You pull out your phone, and against your better judgment, you open your investment app. You know, the One Kite, Grow, whatever you use.
The ritual check-in.
Exactly.
Huh.
And you see it, the sea of red. Or, honestly, sometimes what feels even worse, the flat line.
Hmm.
You've been disciplined. You've been doing the SIP every month, unemotional, automatic, just like every financial influencer tells you to do.
Okay.
But the number at the bottom of the screen, it hasn't moved in 6 months. It feels wasteful.
It does.
It feels like you're literally taking your hard-earned rupees and setting them on fire.
That is a very visceral feeling. And
Mhm.
it is not just impatience, it's evolutionary. We are wired to want immediate feedback for our labor.
Right.
If we work, we get paid. If we invest money, we expect the number to go up. When it goes down or stays flat, our brain screams danger or failure.
It feels like losing the game.
It does. We feel like we are losing.
That's it. It feels like losing. But that feeling is exactly why we're doing this deep dive today. We have a stack of research in front of us that suggests that our biological reaction to a flat or falling market is completely wrong,
Not just be patient wrong, but
but mathematically fundamentally wrong.
it is a complete illusion. We are looking at a fascinating, data-heavy analysis today titled Power of SIP During Bear Run and Bull Run.
And what I like about this source is that it isn't looking at the S&P 500 or some abstract global theory. This is home turf,
Exactly. This is looking right here at the Nifty 500.
which covers the broad Indian market.
Correct. And the data set is massive. It covers 5 specific market cycles in India, stretching from April 1995 all the way to September 2024.
Wow, that's nearly 30 years of Indian market history.
Pretty much.
And the mission for this deep dive is to prove a hypothesis that sounds, frankly, a bit ridiculous when you say it out loud.
How?
The hypothesis is you don't actually make your money when the market is flying high. During the bull run, when everyone is celebrating and posting screenshots of their profits on Twitter.
No, that is the realization of the profit. That is the harvest.
Right. The money is actually made, the wealth is actually created during the boring, painful, flat, or even crashing periods.
Bear market.
Yes.
Precisely. The bear is actually your best friend. You just don't realize it until after the party starts.
So let's unpack this,
Mm-hmm.
because I think we need to get our definitions straight first. We throw around terms like bear market and bull market all the time, but this report uses some really specific definitions for the math to work, right?
This is a crucial distinction. Usually when people hear bear market, they think of the crash.
Yeah, the scary part.
The scary part where the Sensex drops 1,000 points in a day. But in this analysis, they define a bear run much more broadly. A bear run is the entire phase where the Nifty 500 stays below its previous peak.
Oh, that changes the timeline significantly.
Massively.
So if the market crashes in January and it takes 2 years to crawl back up to that January price, that entire 2 years is considered the bear run.
Yes, it includes the fall, the bottom, and the long grinding recovery time. Basically the underwater phase.
And the bull run is defined as,
As the phase where the index finally breaks that previous peak and ascends to the highest point of that specific cycle.
got it. And we're assuming the listener is doing a standard SIP, a systematic investment plan.
Right. Just putting a fixed amount of rupees in every single month on a specific date, regardless of whether the headlines are good or bad.
Unemotional automated investing.
Correct.
Okay, now here's the metric that blew my mind. The report calculates something called the wealth determinant.
It sounds a bit like an academic paper, but the concept is actually quite beautiful.
It is.
It essentially asks this. Imagine you reach the end of a 10-year cycle and you have a corpus of, say, 20 lakh rupees. The wealth determinant asks, what percentage of that 20 lakhs came from the investments you made during the bad times
The bit.
versus the investments you made during the good times?
The bull. So did the heavy lifting come from the stress or the success?
Exactly. And the answer is almost shocking.
Okay, let's look at cycle 1. This takes us back to April 1995.
A different era for the Indian markets. Physical shares, open outcry trading floors. It was the Wild West.
Totally. So cycle 1 goes from April 1995 to March 2000. That ends with the dot-com boom. Now break down the timeline for us.
Well, this was a tough start for anyone entering the market. The bear run, that period where the market was below its peak, lasted for 46 months.
46 months. Wait, that is almost 4 years.
It's almost 4 years of waiting.
4 years. I want to pause on that because we get antsy if the market is flat for 4 weeks.
Right.
Imagine starting an SIP and for 4 years, nearly half a decade, you don't see a new high. You're just treading water.
It requires immense conviction. And the bull run that followed, the part where it actually zoomed up,
Yeah.
that only lasted 14 months.
So 46 months of pain, 14 months of gain.
But here is the shocker. If you look at the total wealth created in that cycle, let's look at the numbers. The total corpus built was about 6.15 lakh rupees in this model.
Okay.
The wealth determinant for the bear phase was 88%.
Wait, 88%?
Yes, 88% of the final wealth came from the units bought during those 46 boring months.
So only 12% came from the exciting bull run phase.
Only 12%.
That is massive. So if you had gotten frustrated in month 40 and stopped your SIP because the Indian market goes nowhere, you would have walked away with almost nothing.
You would have missed the entire point of the cycle. Because think about the mechanics. You were accumulating volume during the bear phase.
Because prices were low?
Exactly. You were buying more units. When the price finally spiked in those short 14 months, it was multiplying the volume you bought during the quiet years.
It's like filling up a tank with cheap petrol for 4 years and then suddenly the price of petrol triples and you're the only one sitting on a full reserve.
That is a very good analogy. If you only start buying when the price spikes, you have no volume to multiply.
Okay, but 1995 feels like ancient history to some of our listeners.
Yeah.
Let's fast forward. Let's talk about a period that I think haunts a lot of investors.
Oh, yes.
The post-2008 era. Cycle 3 in our data.
The lost years.
This is Cycle 3, January 2008 to January 2014. I remember this. It felt like the world was ending, and then for years the market just drifted.
It was dead money,
Yeah.
a test of character. In this analysis, the bear run, the time spent below the 2008 peak, lasted for 73 months.
73 months. That is over 6 years.
6 years and 1 month. Imagine paying your SIP every month for 6 years. You change jobs, maybe you get married, have a kid.
And the index is still not breaking its old high.
Never.
I mean, be honest, most people would quit. They say SIP don't work. They'd pull the money out and put it in a fixed deposit or buy gold.
Many did. And let's look at the math of what they walked away from. In this model, during those 73 months, the investor put in roughly 2.19 lakh rupees. At the end of the bear phase, that corpus was worth 3.15 lakhs.
It's not bad. It's a 12.22% TES IGR. But it's not get rich quick.
No, it barely beats inflation in some years. It's respectable, but unexciting.
Go.
But then came the bull run. From February 2014 to January 2018, the sentiment shifted, the new government came in, the Modi wave era.
Right. Everything moved up. And what was the wealth determinant there?
77%.
So 77% of the total money made in that decade-long cycle came from the investments made during the 6 years of nothing happening.
Precisely. Even though the bull run lasted 4 years, which is a decent length, it only contributed 23% to the final wealth creation.
Wow.
The heavy lifting was done by the patience shown between 2008 and 2014.
This is what I love about this data. It flips the script.
Yeah.
We usually look back at 2008, 2014 as the bad times.
Right.
But if you were an accumulator, those are the golden years. You were getting to buy India's growth story at a discount for 6 straight years.
Buying low is only possible if the market stays low. You cannot buy low if the market is hitting a new high every day.
That is such a simple truth, but hard to swallow when you see red on the screen.
Speaking of seeing red, we have to talk about Cycle 4. Because Cycle 3 had decent returns during the bear phase, 12% is okay. But Cycle 4, that includes the COVID crash.
Oh, the March 2020 drop. That was scary. I remember watching the Nifty just free fall. Lower circuits every day.
So Cycle 4 in our data runs from February 2018 to August 2020 for the bear phase. That's about 31 months.
So that includes the economic slowdown before COVID and then the pandemic crash itself.
Correct. And
Right.
how did the portfolio look?
I'm guessing not great.
It looked terrible. The CAGR during this bear phase was negative 7.12%.
Ouch. So you were diligently putting money in and the value is shrinking.
On paper, yes, you invested 93,000 rupees over those months, and at the end of the phase, the value was only 84,000 rupees.
You're down 9,000 rupees after 2.5 years of disciplined investing.
Yes.
This is the moment where people panic sell. Get me out. The market is crashing. I'd rather keep cash under my mattress.
And that is the worst financial mistake you can make, because look what happened next. The bull run started in September 2020 and went to December 2021.
That post-COVID liquidity rally. Everything went to the moon.
It was a short, sharp rally, only 16 months. But the CAGR during that rally was over 40%.
40%.
And here is the aha moment. Despite the fact that the portfolio was losing value during the accumulation phase,
Yeah.
The wealth determinant for the bear run was still 71%.
Wait, explain that to me. My portfolio was negative. How did the phase where I lost money contribute 71% of the final wealth? That feels counterintuitive.
It is the math of averaging. When the returns were negative 7%, what were you doing with your monthly SIP? Let's say you were investing 10,000 rupees. Because the NAV was low, that 10,000 rupees was buying you more units of the mutual fund.
I see. I was accumulating a massive pile of units because they were on sale.
Exactly. You were greedy when others were fearful simply by sticking to the schedule.
Yeah.
So when the market turned in September 2020, that massive pile of cheap units suddenly repriced upwards.
Ah,
If you had only started investing when the market turned green in September, you would have bought very few units at a high price. You would have missed the leverage.
so the negative returns were actually the fuel for the rocket ship that launched later.
Yes. The red color in your portfolio was just the sign that the great Indian sale is on.
That is a powerful reframing. Okay, I want to play devil's advocate, though. Is there ever a time where the bull run actually wins? What about the biggest boom we've ever seen? Cycle 2.
The early 2000s boom. April 2000 to December 2007. This was the infrastructure boom, the telecom boom, the real estate boom.
Right. And looking at the data, the time split was almost even. 53 months of bear, 54 months of bull.
Yes, very balanced in terms of time.
And the money made was insane. The total invested was 2.79 lakh rupees, and the final corpus was nearly 17 lakhs.
16.85 lakhs to be exact. That's
Yeah.
a 45% CAGR for the whole cycle.
Okay.
It was a golden era for Indian equities.
A once-in-a-lifetime run.
Truly.
Surely, with such a massive long bull run, 54 months of going up, that phase must have contributed the most wealth.
You would think so. It feels like the bull run did all the work, but the data says no.
Really? Even then?
Even in this massive boom, the wealth determinant for the bear phase, those first 53 months from 2000 to 2003 was 74%.
Still 74%.
The pattern holds. The accumulation happened between 2000 and 2003. That provided the base. The bull run from 2003 to 2007 simply multiplied the value of that base.
So if you've got the base,
The multiplier has nothing to work on.
it's strictly mathematical. You cannot separate the harvest from the planting.
And you cannot plant during the harvest. You have to plant before.
Right. The bear market is planting season. So bring us to today, because things have been interesting lately. The source covers cycle 5, which is January 2022 to September 2024.
This is the cycle we are currently living through or just finished a phase of.
And it feels like the market has been pretty resilient, right? We haven't had a 2008-style meltdown.
We haven't. The bear run here, again, time below the previous peak, was 19 months. From Jan 2022 to July 2023, it was choppy, volatile.
Influenced by global wars and interest rates.
Exactly. But not a deep crash.
And the bull run has been roughly 14 months, up to Sep 2024.
Correct. Now, this cycle is slightly unique. Because the Indian market has been so strong, the dip wasn't as deep or as long as previous cycles.
So does the bull finally win one?
It does better. The bull run contribution here is 34%, which is the highest we've seen in this data set.
Okay, so 34% from the good times. But that still means...
It means the bear run still dominates. 66% of the wealth created in this current cycle came from the SIPs invested during that chop and churn of 2022 and early 2023.
Even in a strong market, the pauses, the flat lines, that's where the 66% comes from.
Yes, the total CGI for this cycle is sitting at a very healthy 34.84%. You invested 99,000 rupees and you have about 1.5 lakhs. But 2/3 of that gain is thanks to the first 19 months of uncertainty.
So let's zoom out. We have looked at 5 cycles, 1995 to 2024.
Different governments, different global crises, dot-com bubble, 2008 crisis, COVID.
And through all of it, one number stands out. The wealth determinant column for the bear run never drops below 66%.
It ranges from 66% to 88%.
That is a statistical certainty at this point.
Yeah.
The majority of your wealth in an SIP is determined by what you do when the market is down, flat, or recovering.
It's a paradox, isn't it?
It is the great paradox of investing.
It is. Investors love bull runs because they feel good. The app shows green numbers, you feel rich, you tell your friends to invest.
But mathematically, buying during a bull run is the least efficient use of your capital.
You get fewer units for your rupees.
And investors hate bear runs. We dread them.
We hate them because they feel bad. We feel poorer. But that is the only time you are actually making the future wealth. The bull run is simply the realization of that wealth.
The cash out phase.
Exactly.
So if I'm listening to this and I see the Nifty down 100 points,
Yeah.
or I see analysts on TV screaming about a recession,
You should smile.
let's smile.
You should smile and check if your SIP date's coming up, because you are about to get a higher wealth determinant for your portfolio.
It really changes how you read the news. Market crash just reads like discount sale.
Think of it like shopping. If you go to the mall and your favorite brand of shirts is 20% off, do you panic and run away?
No, I buy two. Maybe I buy one for next year.
Exactly. But in the stock market, when the Nifty is 20% off, everyone runs for the exit. It is irrational human behavior.
We are wiring ourselves to buy high and sell low. When the math demands, we do the opposite.
So the strategy is essentially do nothing. Or rather, don't stop doing what you're doing.
Right.
The strategy is respect the bear. Understand that the bear is doing the heavy lifting for you. If you stop your SEP during a bear market, you are essentially firing your best employee right before payday.
Firing your best employee right before payday. I love that.
It's true. You endure the work, but you refuse the paycheck.
This has been such a clarifying conversation. It takes the fear out of those red numbers. It almost makes you want the market to stay down a little longer.
Well, be careful what you wish for.
No, seriously. I want to leave you with a thought, though. Something to chew on next time you check your phone.
Go for it.
If we really truly know that the bear run is where the wealth is created, should we stop hoping for the market to go up every day?
That is a dangerous thought.
But seriously,
Yeah.
should we actually secretly hope for the market to stay flat? Should we hope it stays boring for just a few more years so we can accumulate more at these prices?
Because if it shoots up tomorrow, sure, we feel good, but the buying window closes?
Yeah.
You are asking people to fight their basic instincts. We all want to see the harvest, but mathematically, you are right.
Right.
If you are in your accumulation phase, if you are in your 20s or 30s and building your corpus, a booming market is actually your enemy. You want the bear to stay a little longer.
A tough mindset to adopt, but the data says it's the winning one.
Absolutely.
Next time you see red, remember, the bear is your best friend. Keep the SIP going.
And let the math do the work.
Thanks for listening to this deep dive. We'll catch you the next cycle.